Facebook report Q4 earnings on the 2nd of February at 5 minutes past 8. And after a period of concern about a rise in operational expenses and the impact that was going to have on gross margins through 2017, the market seems to be of the belief that we're going to see some fairly punchy and upbeat numbers from the company. Facebook do have a very strong pedigree when it comes to earnings. In fact, 8 of the prior 8 quarters we've seen them beating earnings per share assumptions by an average of 12.6%. They've beaten 7 of the last 8 on the revenue side by an average of 3.3%, and the share price reaction on the day after earnings reports has generally been quite upbeat, with the average gain being 5.1% over the last 8 quarters. In terms of this report, we're expecting, or the Street's position, for earnings per share growth of about 19%, paying out $1.30. Revenue of $8.49 billion, which is a 45% year-on-year increase, and very, very healthy gross margins at 87%. Of course, the outlook's very important, and anything that suggests they may beat the full-year estimates of $5.23 and revenue of $36.27 billion will certainly be well received by the market, and we should see the share price gravitate back up to the 130, 140 region. Facebook has a very strong investment profile, and it's a brilliant business. We're seeing time spent on the platform increasing, engagement rates increasing, monthly active users increasing, and video ads increasing as well. And of course, anything that suggests the ability to monetize the ad market even more on the platform will be well received by the market. Instagram's another big area that they need to be looking at as well. With 600 million daily active users and a rising business profile, I think this aspect of the business is very much underappreciated by the market. Facebook is a cheap business for the levels of growth we're getting. Considering the levels of growth we're seeing there, the share price trades on 24 times forward earnings, which is very, very cheap relative to the broader internet sector, which trades on about 30 times. In fact, if you look at this on a price to earnings growth ratio of 0.7 times, you can see it's a very compelling multiple as well. They're trading on 13.7 times enterprise value to EBITDA. So from a valuation perspective and levels of growth that you're getting, this is a very cheap business with a strong investment profile. So what's the company worth? Well, if you look at the 12-month price target, the consensus is the stock should be trading around $150 over the coming 12 months, which gives you some really good share price appreciation. But I think a break of $133.84, which was the recent high, really takes you up to those levels over the coming months.